Thank you everyone for dialing in. I know folks have joined from various different places. So we are battling with Pacific time zone, Eastern time zone, and India time zone. Hopefully this time works for all of us. And I'll try to not keep you, uh, you know, engaged for too long, especially on the EST side. So let's get going. So this is our drill number 2. We had our drill number 1 last week. And for those who are attending this for the first time, before we begin, this uh, TLDR version of this disclaimer is, please, this is just for educational purposes only. This is not an investment, financial, or a tax advice. We are here to learn from each other. So I'm sharing what I have learned in terms of trading options with you, and just take it as that. You might take it as for some little bit entertainment, but don't take it as a professional advice. Consult your financial advisors or a CPA before you take any big action on your portfolio. Okay. All right. Those who don't know me and those who are joining for the first time here, any first timers, do let me know in the chat if you're joining here for the first time. Um, I have worked on software industry. Most of my career has been in there, though I also have worked on a steel plant. So I'm a little bit familiar about manufacturing space also. But over 2 decades of working in software industry, being investing for 15 years, my philosophy is to think risk before rewards. I've been investing in ETFs and the stocks, and then also on options based out of Bay Area, San Jose, California. More you can read about me on my website in terms of how I got into options. I talk a little more detail in the first boot camp. Don't want to repeat the same thing again. All right, so we'll connect here every Tuesday or in the bootcamp sessions, or I also get to meet you on Saturday, where we generally talk about investments and markets, stock markets, crypto markets, investments, S1 stocks, what's new, etc., etc. Out of these 2 sessions, if you want to connect with me or hear my thoughts, etc., so you can connect with me on these various channels. Let me just put this on chat. I do have my podcast, so you can connect me and through the podcast or through my YouTube channel, or you can send me and go to my website, see some content there, or send me a note from there. A good old email also suffice, or I'm also active in Quora and lastly on Twitter. So I just posted the links in the chat if you want to hear my sarcasm or see what I have to say. These are the other channels in which you can connect with me. Okay, for a quick overview of what we're gonna all cover in the boot camp, those who are joining here for the first time. We already talked about the first 2 topics. What's an option contract, put option contract. We already covered these things. We also talked about cash secured put, which is basically a share acquisition strategy for someone who is always traded stock and now want to move into options. Today, in today's bootcamp, we're gonna cover call option contract and the covered call option strategy. So I'm gonna explain these two today. And then we're gonna talk about moneyness, how the exercises and assignment process works. If you have a smaller account, what are the strategies you can use for small accounts? What's the checklist that we should follow? Then we start moving into little more intermediate level things in terms of how to do a multi-leg option trades. You might have heard, if you've already started researching about options, you might have heard of some strategies: iron condors, iron butterflies, strangles, straddles. We're going to talk about all of those. All those strategies, however complex it may sound, are based off basic 2 blocks: call option and put option. So that is why I want to focus and dedicate at least 1 session each on call and 1 on put. If you understand those 2, all other strategies are easy to understand. Then we'll also dig a little deeper into option pricing, understand how that works, find out how we can generate an edge in options. And then we start moving into a little more advanced concepts of if a trade goes bad, what do we do? Putting a trade and hoping that it works is not a winning strategy. If we are dealing only with stocks, there is nothing much that we can do except doubling down, and that may not always work out. But in options, there are various trade management techniques that you can use. If your thesis has gone wrong, your stock has not cooperated, or volatility has not cooperated, there are stuff that you can do. So we're going to talk about 4 techniques. Then we will jump into option Greeks. And this is again a little more advanced if you want to understand why things change, where the risk lies, how do you find risk in your positions. We're going to talk about option Greeks, delta, theta, vega, and gamma. We're going to look at exit checklist. What are the things that you should look at before you exit your option trade? Risk management using options. How you can de-risk your portfolio, and it really doesn't matter whether in a portfolio you have options or you have only stocks. If you are largely have stocks in your portfolio, you could still use options to reduce your risk a little bit. Then we're going to talk about how to manage your options portfolio like professionals do. If your option portfolio is bigger, how do you make sure that you keep an eye on the risk, how to manage it, when to open it, when to close it, what are those telltale signs that will tell you what's your risk on a portfolio. And lastly, some tips and tricks that you will not find in any books, that you will not find in any option journal, but those are things that I've learned from my experience and as a part-time option investors. You might find a lot of stuff which is related to those who are trading options full-time, but if you are part-time, which is how I started my journey, is got into options while working full-time in my job. So there are things that I learned which helped me as not to dedicate a lot, to not to dedicate too much time on options and still get through it. I'll share those tips and tricks at the end. So that's all in the boot camp. So it's going to take some time. We have a lot to cover and we are just on session 2 right now. So I hope you'll stay with me till the end and you'll enjoy. Hopefully, I'll try to make this journey a little enjoyable. You let me know your feedback, how you would want to learn and how we can make it easier for both of us. Okay. And if you have any questions, put it in the chat or in the Q&A and I will answer it if it is relevant to the current content. I'll answer it during the presentation, otherwise we'll take it later. So I see a question saying for the Greeks class and how many weeks that will be. I think the Greek it will be at least, it will be split into 2 weeks. Because delta is one Greek, which I want to get very detailed into. And then theta and vega will cover together. So probably it will be split into 2 weeks. All right, so if you have missed the previous session, like I mentioned, we have a recording on the website. I did send a note to people who had registered on the meetup yesterday, but some of you might have done it today. But if you want to go and view the recording, it's available on the website. Let me just pull it over. Go to optiongig.com, sign up over there, and then you can go to members area, click on a boot camp. You will see the recording of the bootcamp sessions here. So we have the first session uploaded already. It'll take a couple of days for me to upload the recording once we are done. So you should expect it by Thursday to be available on my website. Okay. Right. So quick recap of what we talked about in our previous bootcamp. Option contract, which is a legal agreement between 2 parties. The option buyer has a right. Option seller has an obligation to perform as per the contract. So buyer will exercise the right. and the option seller will be assigned the obligation. So exercise and assignment have two different meanings. We talk in detail about it, these two things using an examples. If an option is not exercised, then it expires worthless. Every option strategy, like I told earlier, is built using the very basic building blocks, basic Lego blocks, put options and call options. Then in the cash secured put, we talked about how selling a cash secured put is a share acquisition strategy at a desired point. We also took an example to understand why it is better than just putting a limit order, because you get paid while you're waiting. If you put a limit order and stock doesn't hit your limit price, don't get the shares, nor to get paid for your time. So the better is maybe use a sell a cash secured put. It also reduces the cost basis of shares by the amount of premium that you collect when you open the trade. If the share does get assigned, which you wanted to have it anyway at your price, still you reduce your cost basis because you got some initial premium. So I also refer this as a transition strategy. This is the first one that I did, because for after being just a stock or ETF investor for more than a decade, when I started on options, we don't want to, just dive directly into options. We want to dip our toe to see and understand how options work. So couple of strategies are those transition strategies. First one was cash secured put that we already covered in a previous session. Today's session, we're going to talk about other strategy. And then I also gave you homework. So like I said, this is a boot camp in which you come and learn, and then you also get a homework. So just want to make sure if you have done your homework. The first one was to enable your accounts for options trading. When you open an account with the brokerage house, it is not by default, you don't get option trading privileges. You need to sign for separate documentation to enable your account for options trading. Do let me know. Anyone who has, I'm assuming that every one of you have done this homework and have now option trading enabled for an account on your accounts. Anyone needs any help in that, do let me know. Or if there's anyone who has not got your account enabled for options, then we need to chat separately. The reason is, if you don't do these things as we move along, I'm afraid you'll be here 6 months later going through the same thing again. Don't be like me. For 10 years, when I go for Lake Tahoe, I always take a beginner lesson. I've taken those beginner lessons 4 times now. And my kids now laugh at me that, Dad, you always go and take a beginner lesson. What do? I go and take a beginner lesson and I don't go there for another 2 years. And I go and repeat a beginner lesson. I've already repeated it 4 times. You can do better than me. Go ahead, enable your account for options trading so that you can start doing some trades. It's only if you do it, you'll get into the grind, and then you will remember how to, get started. Should watch the video. I also talked about it in the first session. Before, if you have not opened your account yet, there is a YouTube video which I have created in terms of how you should answer the questionnaire intelligently so that you can get a privilege that we need. And then you were to find a company in which you wanted to buy 100 shares and sell a put option. I hope all of you have done that. So let me know if any one of you needs any help in that regard. Any questions on what we have covered in drill number 1? It's your time to ask questions. Before I jump into the call option, I thought maybe I'll quickly tell you, if you are getting into options for the very first time, which I believe all of you are, is what are some of the things that you need to make sure you can see in your brokerage platform. Okay. And again, this is sink or swim. If you have any other brokerage platform, it's fine. I'm not discouraging or promoting any one system, but just make sure you can find these pieces of information which will be important when you are doing an option trades. So first is obviously where the ticker is. So these are the on the left hand side, and if your brokerage platform shows it in a vertical fashion, you will see on the left hand side we'll have a calls. On the right hand side, all the puts are listed. In the middle, you see these are the strike prices. So while I was given an example saying sell a put at a strike price of 40 or sell a put at a strike price of 50, these are the things I was talking about, sell at a strike price of 50. You will see the bid and the ask, which is similar to how we have a bid and the ask on the stock. Then you should be able to see how many volume, what's the volume on it, how many contracts of put or on the call side are being traded today. Other thing you should be able to find out, and I will deeper into this, is what's the delta of this option. Again, if you are just enabling your account, make sure you can figure out on your trading platform where to find this information. The delta against each of the strike price. And lastly, what's the extrinsic value? And maybe some of the platforms don't show the extrinsic value. In that case, you don't have much option. Then we'll talk about how to deduce or derive an extrinsic value. May not be exact, but close enough. Okay. But if your platform shows it, great. These are the basic minimum things that you should know on how to find this, right? For a particular expiration period. So this particular strike prices are for an option contract that is expiring on 15th Jan 21st. Now we could have a same thing, but for a different option contract. If instead of January, you want to look at April, you'll have the option contracts for April. So a quick overview I just wanted to give is make sure on your trading platform, you can find these things. Some of these things may not make sense to you right now because I haven't touched those in a boot camp. For example, delta, why do you need it? What is extrinsic value? So I'll cover those when we talk about option pricing. I'll cover delta when we're talking about option Greece. But these are the things which you will find it useful. Yeah. Now, if you have to sell an option, say if I were to sell this is what snap. If I were to sell a 45 short put because I don't want to buy snap today at 51, but I'll be okay to buy it if it comes down to 45 at expiration. I will sell, means I will click on bid, and this is how it will create a sell order in Thinkorswim. Whatever platform you're using, look into it that you're selling and it is a put option. Your expiration period is correct. Your strike price is correct. And then how much you're getting paid. In this case, I'll be paid at minimum 83 cents. So if stock doesn't fall down to 45, I have earned 83 cents for waiting for 31 days, which for me is, if we have to earn 83 cents, it's close to 1.8%. Not great, but decent enough. If you do it over and over again, you still got your 18% ROI, return on capital, for if you do it 12 times a year. So this is how some of these basic things you need to Be aware and get comfortable on your trading platform. If your trading platform provides paper trading ability, use that paper trading ability to become comfortable with the, you know, the overall layout and the mechanics of your trading platform. All right, so let me see any question. Can you explain extrinsic value? We'll do it in our later sessions when we talk about option pricing. That time I will cover the extrinsic value. Can you give an example of shorting Dash? I don't know if you're looking to short Dash directly as a stock, then you have to just sell the stock and make sure you have privilege to do it, because not everyone may have a privilege to short the shares. But if you're looking for doing a bearish trade on DoorDash, maybe let's talk about it in our Saturday session where we discuss on various trading opportunities, and then we can figure out how to maybe form a trade on Dash. So today's session, I just want to focus on education around options. If you have a question on specific trades, let's do it on our Saturday session. All right, let's jump into call option contract and start for today. Say, Susie owns a house that's worth $500,000 today. And the reason I'm bringing this real estate example is it's much easier for someone who is trying to get into options. If we talk about taking some example which is from a real life, which many of you might have dealt with real estate. If not you, your friends or your relatives, you might have seen them buying or selling house. So probably might be easier for you if you go through this example. So Susie, she owns a house, and the house price today is $500,000, and she wants to sell the house. Like I said, price is $500,000. Bob is a buyer. He wants to buy the house. So Bob brings a proposal for Susie. He wants to buy it, but he doesn't have money right now. But he's expecting a good bonus by the end of a month. So he needs 1 month to arrange for the funds. But Bob is a little scared that the house may not be around a month later. So he brings a proposal to Susie and tell, you know what? I'll give you $20,000 right now, today. Take your house off the market for 1 month. So he enters into a contract with Susie, pays $20,000 to Susie right away, and earns the right to buy the property at $500,000 within a month. So if Bob decides at the end of a month that he doesn't want to buy the property, Susie will keep $20,000 that Bob has given. But Susie will have to take the house off the market for 1 month, and for doing that, she's getting $20,000 up front today. So this is a transaction that Bob and Susie are entering into. So let's look at what could happen a month later. House price could go up. Instead of $500,000, it could be $530,000. That's probably what's happening in Austin or in Dallas right now, because a lot of companies are moving their headquarters. Recent news was that Oracle is moving. HP already decided that they'll move. Mr. Elon Musk, he has already moved. So maybe this house is in Austin. A house could go up to $530,000. So for Bob, he's happy because he had earned the right to buy the house at $500,000. So a month later, doesn't matter what the market price is. He will still go to Susie and say, we signed a contract. I gave you $20K up front. Now I want to exercise my right to buy the house at $500,000. So he'll be happy because he got a house at 10K lower than the current market price. For Susie, she's also okay because she was looking to sell her house a month earlier at $500,000. And she somewhere from some place, Bob came and offered her $20,000. So in fact, her net inflow has been $520,000. $20,000 she received upfront, and now she will sell the house for $500,000, which she was okay to sell anyway a month earlier. So she wanted to sell her house for $500,000. She got to sell it for $500,000, but she got $20,000 upfront. So it's a good deal for her as well, unless she has a seller remorse. You never know what could happen in the market, right? So for her also, it's a fine deal. But house could have gone down in value. What if it's gone down in value? Instead of 500,000, now it is 470,000. So Bob will just walk away from the deal because he says, why would I buy it from Susie at $500,000 when I can find an equivalent home at 470K in the market? So he will just go and he'll say, I don't want to exercise my right to buy the house at $500,000. Thank you very much, Susie. It was a pleasure working with you. Keep the $20,000 that I gave you. Bye-bye. I'll see you some other time. He'll walk away. Susie, she got her 20K already. So her cost basis of owning the house is now $480,000 because she received 20K premium. So her loss is now only $10,000 instead of $30,000. If she had not entered into this contract with Bob and she was still holding a house of $500,000, a month later, her loss would have been $30,000. Now, her loss is just $10,000. House could have remained unchanged. So I see a typo here. It should have been $500,000. So if a month later, the house price is or $500,000 or $520,000, Bob could decide whether he wants to buy it at $500,000 or not. Because if he buy it at $500,000, he had already paid 20K as a premium earlier. So his cost basis of overall cost of owning the house will be $520,000. But probably it's not a typo. So Bob can decide whether he still want to go ahead with this transaction. If he was buying the house for living in, probably he will go ahead. But if he was buying the house just to flip and make some profit, he may choose not to because the house is now priced at its cost basis. So there's no profit. And for Susie, she still retained 20K. And if Bob buys the house, she'll sell the house. If not, she still has her 20K. So these are the different scenarios. We looked at how Bob and Susie get into this transaction. Bob went into this transaction. Why? Because Bob paid 20K and he had a control on an asset which is worth $500,000. And in this case, his maximum loss is limited to the initial 20K that Bob had paid. So going back to previous slide, instead of $470,000, what if the house was damaged and in a month and the house price was $200,000? Bob will just walk away. He doesn't really have to buy the house. So his maximum loss is limited to the initial amount of $20,000 that he paid. So that's why Bob entered into this transaction. But why Susie got into this transaction? Her viewpoint was she got money up front to wait to sell the house at a price at which she was willing to sell it anyway. She had already put it on Redfin, though now the seller don't mention what's the price of that they want to sell. But she's already sounded out to her, let's say, her agent that she's okay to sell it at $500,000. But she got additional 20K upfront to sell the house at a price at which she was anyway willing to sell. But she had to wait for another month. Now, she didn't have many other buyers lined up, so it was a good deal because she got 20K. But if there were more buyers asking for the house, then Susie wouldn't have done this deal in 20K. She would have demanded a lot more initial premium or a lot more money to take the house off the market. In the end, it's a demand and supply game. So there were not many buyers. Susie wanted to sell it at 500K. Bob came along and said, I'll give you 20K. I'll buy it at 500K. Just give me a month. So she was like, okay, I've not received any other offers till now. Maybe I'll take Bob's offer to wait for a month. So that's why both of them entered into this transaction. So in a way, it is both of them had their own viewpoint of why it is beneficial for them. So the transaction that we just saw, this was an example of a transaction in call option contract. Now let's replace the house with a stock ticker, your favorite stock ticker. Let's say it's Snapchat, ticker symbol SNAP. So what happened in this particular transaction? In this one, Susie, she wrote a contract and Bob bought that contract. So she wrote a contract to give Bob a choice or an option to call her house or to buy her house at a strike price of $500,000. So Susie wrote an option contract to Bob which gave Bob a right to buy the house from Susie at $500,000 for 1 month. And for this consideration, Bob paid 20K of premium to Susie. So in this case, Bob became the buyer of that option contract. Using that option contract, Bob can call the house or buy the house at a strike price which they agreed, which was $500,000. And the premium is 20K. The time available is 1 month. So what's a call option contract? It's a contract that gives the buyer of the call option contract. Remember, Bob bought the call option contract. Susie wrote the contract. So Susie has an obligation, but Bob has a right. Remember, we looked at a use case where the house fell to 470,000. Bob walked away. He says, I'm not going to exercise my right. So Bob was a buyer of a contract. So he's got a right to buy the stock at a specified price within the specified time period. That's what a call option contract is. Now for this choice, the call option buyer has to pay a consideration amount, a premium amount to the call option writer or to the call option seller. In our example, the call option seller or the call option writer was Susie. So Bob paid 20K, which is a premium amount to Susie. Now, because Susie received this premium amount, there's no free lunch here. Because she received the premium amount, now she's obligated to do something, which is that if Bob wants to buy the house, she will have to sell the house. She can't say no. So in case if you're selling a call option contract and you get assigned, you have to sell the stock. So option seller is obligated to sell the stock at the specified price whenever the call option buyer choose to exercise his right. So this is in plain simple language. How a call option contract works? So if you're a call option buyer, you're getting a right to call the shares at the strike price within the expiration period. Anytime. There was a question in quiz. Do you have to hold it all the way to expiration? No, you can exercise it anytime. If you're a call option seller, whenever you get assigned the contract, you have to sell the shares. Let me see if there are any questions. Okay. Can we also earn premium by selling calls if you are bearish on stock? Yes, you do get a premium when you sell a call, but selling just a call without owning a stock is also a risky game. If you are just starting into options, I would suggest you not to do that. Anyway, your brokerage firm won't even give the privilege to sell a naked call. But if you own the shares and then you want to sell the call against it, that's what we're gonna talk today. It really doesn't mean whether you're bearish or not. Sometimes it could just be to generate some consistent income. See, premium is always short-term capital gain. Yes, because depends on if you have sold an option contract. If it is more than 12 months out, which is what called a leap contracts, in that case, it could become a long-term, because by the time you close that contract, it will be 12 months out. But I generally don't do that. There are very specific use case where I will do those leap contracts. Otherwise, mostly it will be a short-term capital gain. If you're doing 60 days, 45 days, which is what the sweet spot is. Mathematically, we have seen in the back testing. So yes, that will be short-term capital gain. Okay, any other questions? Looks like no. Okay, let's move on. So an option contract main elements in a call option contract, you need to have an underlying. In our example, it was a house. But when we are actually dealing in a stock market, it will be a stock or ETF or any ticker, right? In this case, let's say Snap, which is SNAP, a ticker symbol of company Snapchat. How many contracts are included in this option contract? Am I selling one contract? Am I selling two contracts? Or if I'm buying, am I buying one or two contracts? Now, generally, when you're dealing in option contract, there are 100 shares in one option contract. So for example, if I buy this contract, even though it says 90.90, if I buy this, I have to pay $90 because one contract has 100 shares underneath it. So this is what it shows here, that it is 100. So if I buy this, it will tell me my overall cost of this trade is $90 plus of course the commissions. So it will be $90. So one option contract in this case is having control of 100 shares. This is what most of the time is. And I don't want to get into now the scenarios when you have a stock splits or other stuff in which you'll have some irregular contracts which will exist for some time. But for all practical purposes, one contract has generally 100 shares underneath it. What's the date of expiration? Bob got it right for 1 month. Now in case of Snap, I could choose 30 days, 1 month, or if I could choose 122 days out. And say if I want to buy, today the Snap is at 51, I want to buy the Snap at 50, I want to buy a call contract, I have to pay $8. But this $8 will give me a right to buy the shares of Snap at any time up to 16th April 2021 at a price of $50. So expiration period, another main element in any option contract. What's the strike price at which I want to buy that underlying asset? In house, the strike price was $500,000. In this case, the strike price is $50. What is the type of a contract? It's a call contract. And what's the amount of premium? In this example, the premium that I will have to pay for a contract that gives me right all the way to 16th April 2021, I have to pay $8. If I want my right to be available only for next 30 days, then I have to pay less money because the less time. Then I'll have to pay $3.90 or $390. But the moment clock ticks over your exchange closing time on 15th Jan 21st, it's gone. My right is gone. I cannot go and then ask on a 16th Jan or whatever the next trading day, I cannot go and say, now sell me the shares. I want to buy the shares at 50. It's over. My right was valid only till this date. So that's the expiration period. That your right is valid only till that expiration date. So these are main elements in any option contract. So by looking at an option contract, you should be able to determine what's the ticker in it, what's the expiration date, what's the strike price, what type of contract it is, and what's the premium amount. Most of the time it will be 100 in terms of the number of shares. In unusual cases on splits or reverse splits, this thing could change. But that's a discussion for some other time. Okay, I see a question here. After the contract is assigned, does the buyer still have time until expiration date to exercise it or a shorter deadline? So first of all, a contract assigned means it always is assigned to the option seller. Okay. Now I'm assuming that you are an option seller and now the contract has been assigned to you. Depends on brokerage firm, how much time do you have? Generally, brokerage will give you 24 hours to close the trade. Most of the time, and if you're just starting off, if you're selling a call, you will not be able to sell an uncovered call or a naked call. You will have to have a stocks in your portfolio. And then when your call get assigned, your stocks will be removed. They will be sold to the buyer. So it will happen immediately. See another question. If the strike price is reached and the expiry is passed, is the option automatically exercised? So if on the date, if the contract is still valid, say on the date of expiration, if your strike price has reached, and we will talk about it if it is in the money, and that's why I don't want to introduce that term right now. Our next session will be moneyness. But the way it works is, let's say in this example of Snap, if I have sold a contract of Snap at a strike price of 55, and it is valid till 15th Jan 2021. It's like, let me just make sure okay. If it is valid, this contract is valid till 15 Jan 2021 at a strike price of 55. If the stock is at $55.01 at the end of 15 Jan 2021 trading time, then this will automatically be assigned to me. And from my account, 100 shares of Snap will disappear over the weekend. That is how it works. This is called auto assignment. Most of the brokerages in US, that's how it works. I'm not sure about how it works on other countries. I know there are some folks joining from India, so you might have to check how exactly the exercise or assignment process works there. Okay. All right, no further questions. Okay, let's move on. All right, so the example that I gave, just how it looks in a visual, the visual I taken was of yesterday, where the strike price of 53, snap has obviously the price has changed. The moment the price changes, everything else changes. So in this case, we have sold a call of snap. It's a call. I've sold a call, that's why I'm clicking on bid at a $3, strike price is 55. Exercise versus assignment, same concept, irrespective of whether it's a put contract or a call contract. The buyer of the contract has a right to exercise. It is a right. It's not mandatory. If buyer choose to exercise, he or she will. If not, he or she will not. Because if the conditions is not profitable, then they will not choose to exercise the contract. When the house value had fallen down to 470,000, Bob didn't choose to exercise the contract to buy the house from Susie at $500,000. Why? He would rather go to the market and buy it at $470,000 if the similar house is available at 470K. Why would he buy from Susie at 500K? Doesn't make sense. So Bob, chose to forego his contract, so the contract expired worthless. Seller will be assigned the contract. So when we talk about contract being assigned, or we have to take an assignment, we always talk from a perspective of the contract seller. I'm not talking about the underlying, I'm talking about the contract seller. So Susie wrote the contract. Susie was option writer, Susie was option seller, so she will be assigned the contract. If it is not exercised, then the contract is said to have expired worthless, and Susie retained the initial amount, $20,000, which was paid. Even if the contract was assigned, Susie will still retain $20,000, but she will have to give away her house because it was assigned. But if it expires worthless, she retains that 20K. She doesn't have to sell the house because Bob didn't ask for the house. Bob let the contract expire worthless. He didn't ask for the house, so she still owns the house, plus she has 20K. See a question in covered call. So I will come to this question while I talk about covered call. Okay, buying call. So there was some question saying buying, long is buying. Yes. When you talk about buying, whether you are buying a share means you're long on share, you are bullish on shares. Unfortunately, in options, if you buy an option, depending on what type of option it is, you could be bullish or bearish. But when you're saying long option contract means you're buying something. When you're short means you're selling something. So buying a call, i.e. long call. Buying a call contract, if you are buying a call contract, it gives you, the buyer of a call contract, a right to call or to buy the underlying from the call option writer or the call option seller. This is one way in which you can remember call means buy or call means sell. So first of all, option buyer, and then if you're calling, you can call the house or you can buy the house, or you can call the stock, means you can buy the stock. Get the stock in my portfolio. How do you get it? You get a right to buy the stock at a price specified in the option contract anytime. You don't have to wait all the way to expiry. Anytime on or before the expiration of contract. Once you have reached the expiration time, it's over. Contract is not legally valid. Then if you want to really still want to purchase it, you have to buy another contract. It's like your insurance contract. Insurance company is selling you an insurance contract. We bought an insurance contract. We pay a premium to insurance company. My insurance expires at a particular date and time. If I do not renew it before that, And if anything happens to my car after that date, I can't go back to insurance company and say, hey, I got a contract, you have to agree to pay me. No, that contract is not valid anymore, it's expired. Same is the case with the options contract. It's valid only till the expiration date. After that, it's gone, it's worthless paper. Anyway, we don't have a papers, it's all electronic. But for getting this right, to buy the shares anytime before expiration, you have to pay a premium. Now let's look at selling a call or a short call. Instead of buying a call contract, if I'm writing a call contract, or if I'm selling a call contract, or if you are selling a call contract, you are giving a right to someone else. A call contract has got a rights in it. If you buy it, you earn the right. If you sell it, you give the right to someone else. You're giving the right to someone else to call the shares from you. With this, you are taking an obligation to sell the shares when those are called from you. So if you are writing a call contract, then you're taking on an obligation that whenever the shares will be called, and it is called by assignment of the contract, when the contract will be assigned, you will sell the shares. You cannot then say, I don't want to. No, you have an obligation. You don't have a right to say no. You have to perform your obligations. So when you write the option contract, you give the call option buyer a right to call the shares from you at a price that you have already agreed upon anytime on or before the expiration. And for giving away this right and taking on this obligation, you receive a premium, because you're obligating yourself to do something. There's no free labor, there's no free lunch in this world. So if you're obligating yourself to do something, we got to pay you. So the call option buyer will pay you with premium. So last slide before that, let me see if there are any other questions. So the bidding happens on the premium. The bidding, you don't really kind of a bidding happens. It's just like on a stock. So for example, if I want to buy the stock, I will try to buy it at 51.20. I might lower it and see if anyone picking it up. Same is the case with options. You have a bid or a ask. If you want to buy an option contract, currently says 251. You might want to see if anyone is picking a 249. Send it. Nothing happens. Change your price to 251. Probably contract will get executed. It's the same concept like we have in stocks. Similar. There are buyers and sellers of option contracts, and this is what is termed as option chain. This area, option chain will show you at what is the bid price in the ask price of a contract at each strike price. So if you're only dealing in stocks, there are no concept of strike prices, right? Is the stock, what's the current price of stock? If you want to buy it, you click on ask to buy the shares. If you want to sell it, you basically sell it at a bid price. It's easier if you sell it at a bid price, it will get immediately executed. Or you can do it at a market price. You can also do the same thing with options. I don't suggest you to do at a market price though. Either you can click on a bid or ask, or you can say, you know what, do it at a market price. But I would suggest you never ever use market price in options. This is one rookie mistake I did. I think it was my second or third week for options, because in a stocks, when we're dealing with the stocks, we are so habitual of buying it at a market price. So I was like, how big is the difference gonna make? But it does make a big difference if you're buying it on a market price. So don't ever buy it on a market price. Just always put a limit order. Always go on a limit order. So this is how, if you want to term it as a bidding, it could be. But this is how it works. Yes, those are the market makers. Like on a stock, we have market makers. There are market makers who will set up this bid and ask price. And that what determines the premium amount. Premium amount also changes based on what the other factors are, volatility, etc. But essentially, at the end of a day, it's the market makers who will define what the bid and the ask spread is, depending on how liquid the stock is, what's the volatility of a stock. There are factors that get into option premium, including all those. These are defined by the market makers. All right. So takeaways: option contract is a legal agreement. Buyer has a right, seller has an obligation. Option buyer will exercise the right. And I will have these questions in next quiz. Not all, some of them. So make sure to get all these right. Seller will be assigned the obligation or assigned the contract. If it is not exercised, it expires worthless. Every option strategy is built using puts and calls. So now we have covered both the basics of puts. We covered in bootcamp number 1. Now number 2, we've also covered the basics of call options, how it works. If you're buying a call option, what are your legal rights? If you're selling a call option, what are your legal obligations that you need to perform? With this, it comes to the end of a call option. Any questions? Throw it up in a chat. Otherwise, I will move to the next newbie strategy or a transition strategy using call option. Okay. All right, quick housekeeping. Looks like we have 37 minutes. So let's see, hopefully we won't overrun, but it might be possible that might take 5-10 minutes extra than what I had scheduled for. So my apologies, I'll try to finish it with time. Okay, let me bring up the other deck for just see. Okay, we're going to talk about an option trading strategies for newbies. This is the second option trading strategy. The first one that we looked at in bootcamp number 1, in drill number 1, was cash secured put. That was for us to acquire the shares at lower than the market price, but we wanted to get paid while we are waiting. And if we don't get shares, it's okay. I got paid for waiting. Now we're going to look at another strategy, which is I want to sell the shares, but I want to sell it at a higher than market price. But I want to get paid. Time is money. So I want to get paid while I'm waiting for shares to hit my target price. That is called covered call. So there are 2 motives I'm going to cover. First is that I just spoke about, that you want to sell it at a higher than market price, but I also want to talk about something else for generating a consistent regular income. Yeah. All right, I see one question, so let me answer that before I jump into this one. Is there a market to buy and sell contracts prior to their executions? Executions, you mean to say the exercise or assignment? If that's the case, yes. So wherever you bought a contract, so for example, if I bought a contract, an option contract, and so in my account, I can just go and sell it immediately, or whenever I want to, I can sell it or put it at a limit price. So hang in there. Maybe at the end of a session, I will bring up my live account in which I can show you. This one is a simulated environment. Let me check if there is anything I have it in this. Is there any option contract already in? Oh yeah, there is one. Okay. So for example, I have these contracts, XLF. Oh, XLF. So I have this XLF contract in my portfolio. The ticker is XLF, expiring on 31st December. Strike price is 22. It's a put contract. I have sold it at So I've sold 2 contracts. That's why it is -2. So we really want to look at when did I do it. Let me go back and show it. Was done on 9:30. So let's go to account statement, look at XLF. So there you'll see I had sold it on 9:30. I opened this trade by selling. That's why you see it as sell 2 contracts, put contracts, and I got 81 cents as a premium. Now I have this in my account. I want to close this contract right now. I'll say create opposite order. I will close this contract. This contract has been profitable. I got 81 cents. I can close it for 4 cents, means I have 77 cents in my portfolio. I retained 77 cents. So I can close it and send it. So this is, you can, if you have sold a contract, you can close it anytime when you want to. We had a question and quiz. You don't really have to wait until it expires or until it gets assigned to you. If you changed your mind, go ahead and close it right away. I hope that answers the question. Okay, let's jump into covered call. And there is one question on covered call that I will answer later. So profile that I want to look at when you could use covered call is the investor profile is you have a shares in your account. Those shares could have come to you, maybe your company gave you as a part of your employee stock option plan, or some rich uncle gave you an inheritance. I don't care how those shares came into your account. At the end of the day, you have shares in your account. Or maybe you bought those shares because you were you were just dealing in stocks and you were buying shares or ETFs. So I will use the term share, but it applies to shares, ETFs, any of those underlines. Right? So you have some shares in your account. That's your profile. Your motive is, I want to sell the shares, but not at the right price, the price which is in the market right now. I want to sell it at a better price. One, this could be your motive. Or I'm long-term bullish. I don't really want to, I still want to hold my shares, but those shares are doing nothing because I have a shares in a new growth tech company that don't pay any dividend. So say I have a shares from my employer, and I work for a new tech employer. They don't pay dividends. Those shares are lying in my portfolio, doing nothing. How can I generate some income from those shares? Is another motive. So we will see some use case of how you could do both of these things. Let's look at motive one. Motive one was that you want to sell the shares at higher than the market price. So you bought 100 shares of Snap at 48. The current market price is 53. When I say current, means a day earlier because that's when I took the screenshots. So now the price would have changed, but I think from an illustration perspective, this should just work fine. So you bought the shares at 48. Share is already at 53. But you want to sell it at 55. If next 30 days it goes to 55, you're fine to sell it at 55 because you'll say, I'll make $7. So what can you do? What we have been doing till now is you put a limit sell order at 55 on your brokerage platform, and you go and say either it's valid, generally we'll say valid today or valid good until canceled, or you'll say it is valid for next 30 days. In this specific scenario, you're going to go and put a limit order or limit price is 55, valid for next 30 days. Or the other way to do is you sell a call option at 55 for the expiration period, which is closest to 30 days. You may not always get 30 days, but figure out which is closest to 30 days. Or the duration for which you are okay to wait. If you had done this, the sell a call option day before yesterday or yesterday, whenever I took the screenshot, you would have received a premium of $3 upfront. When you executed the trade, you would have got a premium of $3. So these are the two ways. If you want to sell if you are okay to sell your shares at 55, means if a share gets called away from your portfolio at $55, either you can put a limit order or you can sell a call option. So that was a screenshot when I took. Share was around 53. We sold a call option 15 Jan at a $3. Eventually get probably 310, but from a simplicity's sake, say you got $3, you have to wait for 33 days. 15 January 21 is 33 days out. Strike price was 55. So what happens? Let's look at various scenarios. Now this is 15th January 2021. You were okay to wait for next 30 days. You are doing the role of what Susie had done. You received a premium upfront, $3. Let's come to 15 Jan 2021 and see what's happening in the market. Stock is unchanged. Stock probably has moved in between, but on 15 Jan it is still unchanged. If you had put a limit order at 55, stock isn't sold because stock never went to 55. It has always stayed below 55. And on 15 Jan, it is still at 53. Stock isn't sold. You still retain the stock in your portfolio, but you are not compensated for your time. So your cost basis, you bought the shares at 48. Your cost basis of shares is still at 48. Your return on capital is 0%. Limit order doesn't value your time. Don't get paid while you're waiting. But if you sell a call option at 55, stock isn't called away because stock is still at 53. But you got an initial premium of $3. So you got $300 in your bank account. So your cost basis is now reduced. From 48, it has become 45 because you got $3 premium. So your return on capital is almost 6.25%, which is you bought the shares at 48, you got $3 is 6.25%, and you have to wait for 30 days. You do this only if you're okay to sell it at 55 and you don't have any remorse. If it's not getting sold, you still made 6.25%. You could do it again, depending on where the next price is. But at minimum, you will make 6.25%. If the stock gets sold on 55, because in the market now the stock is at 56 or 57 or 55 and 50 cents, you will still have to sell it at 55 because you'll be assigned that contract. So you will still make $7 anyway you will make because you bought it at 48. Plus you made $3 from a premium, you made $10. In case of limit sell order, you would have made only $7. Let's look at other case. Stock is down at 45. Okay, I'll come to the question later. Stock is down at 45. If you had a limit sell order at 55, nothing happens. Stock is not sold. It didn't hit your limit price. Not compensated for time. Your cost basis is still 48. But now you're losing $3. Your loss is $3 because now stock is at 45. You bought it at 48. You're having loss of $3, which is return on capital is negative now. But if you had sold a call option at 55, stock will not be called in this case also. Because if I were a call option buyer, you have sold a call option to me. Why would I exercise my right to buy the stock at 55 from you, I will go and buy the stock at 45 from the market. So I will not exercise my right. Means the option will expire worthless. Means you still have your $3 premium and you still have your stock. But you got paid while you were waiting. So your cost basis now is $45. Because you bought it at 48. It's like you got $3 for selling this call option. Your cost basis is 45. Your overall portfolio loss is still break even. Your portfolio is on break even. Your return on capital, you're just even. So even though the stock is down by $3, your portfolio is still okay. Your break even is at 45. If the stock falls below 45, that's where you start to lose money. But if you just had a limit sell order, you start to lose money anytime the stock goes below 48. Let's look at the third scenario. Stock hits the target of 55, or I should say 55 plus 1 cent. Your stock will be sold at 55. You're happy. You wanted to sell it at 55. It's sold at 55. You made a profit of $7. Your return on capital is 14.5%. Great. In case you have sold a call option, stock will be called away at 55. Means you have to sell, your stock is sold at 55. So you made a profit of $7 plus the initial premium that you had. That's yours to keep. No one is going to take away that premium from you. So your overall profit in this case is $10. $7 from the sale of the stock because you bought it at 48, selling at 55. $7 from the sale of the stock plus $3 by selling the call option. Your overall profit is $10. Your return on capital is not 21%. So your gains are amplified. Let's look at one more scenario which is becoming common in recent times, is that many of the stocks, they just rocket to unrealistic numbers. Say if this stock would have gone to 60. In your case, the limit sell order, it would still be sold at 55. Because if it had hit 55, the moment it hit 55 and above, it will get sold. You still made $7, return on capital 14.5%. In call option, same scenario, you still make only $7. But in the market now it is 60, but your stock will still be called away at 55. So in both cases, your gains are capped because either you put a limit order or you sell a call option. In both cases, whatever is the strike price you have chosen, that's where your maximum profit will lie. All right, so let me see if there is any question. Otherwise, I'll move to motive number 2. All right, there is one question. In covered call, can you purchase stock through options while you are selling the stock instead of already having the stock through prior stock purchase? So it depends on what kind of option privilege you have. If you don't have stock in your portfolio, and then if you're trying to sell a call, it becomes naked call. Or what you could do is to do both the transactions, both the steps in a single transaction. For example, you could buy the shares and sell the call on it immediately as a single transaction. It depends on how your brokerage platform supports it. Thinkorswim does support doing both the steps together. Means if I were to go and say I don't have Snap in my portfolio. Okay. So if I sell a call, this will become uncovered because it is not covered by the stocks in the portfolio. So I will not be allowed to do it if I'm just starting on option trading because I won't have a privilege to do it. In that case, what I could do is I could say, is it covered stock? And it's the other way around. I will do this. In this case, I'm actually buying 100 shares of Snap, and then immediately I'm selling $48 call. So instead of 48, why would I sell 48? It's 51. I want to sell it at a higher than market price, say 50. Okay, what option strikes are there? 55 is there. Now, this one, I'm doing both in a single transaction. So yes, you could do both as together. If you don't have a stock, you could do as together, or what I could have also done is buy the stock, confirm and send once it is executed, and then I could just come and sell a call. You could have done in 2 steps. If a platform doesn't support doing both in together, one single step, you could do it as a 2 separate steps. Or you could do it as a single step, like I just showed. Okay, selling call contract equal to covered call. So when you sell a call contract and you have a shares in your account, that's what it is called, a covered call. And for now, yeah, just limit it over to that. If you don't have a shares, then it is not called covered call. It is called naked call or uncovered call, because you don't hold the shares. So your call option is not covered by the shares in your portfolio. Uh, Closing is buying or selling. It depends on what your opening transaction was. So this is something which stumps anyone who's moving from stock to options, because generally 99.9% of retail investors, our first transaction when we're dealing with the stock is to buy. 0.01% will actually, their first transaction will be to sell without even owning. Those are short sellers, right? Most of the retail investors, they don't do short selling. So in generally in our stocks, most of the retail investor, our first step is, our opening transaction is buy, then our closing transaction will be sell. Now in an option case, it could be different. I already own a stock. So I will open my transaction, covered call, by selling a call option. And then when I have to close this, I will buy it back. So it's not always that close is buying or close is selling. It depends upon what was your opening transaction. The closing will always be the opposite of opening. If I bought a call option as my first transaction, when I opened my transaction, I bought a call option, then I will close it by selling the call option. If I own a stock and I want to do covered call to get some premium, then my opening transaction will be selling a call and my closing will be buying the call back. Okay, I think I'm done. It is, yeah, if you're starting for the first time, it does become a little confusing, because we are not accustomed. Those who are professional only in the stocks, they could do. For example, I don't hold, let's say I don't hold stock Snap in my portfolio. I can still go ahead and sell 100 shares of Snap. In this case, my opening is, I sold Snap shares as an opening transaction. I sold it short. But because most of the time retail investors don't do it, so it is a little confusing for that. Okay, is when you buy a put, that means shorting. So selling a call, same thing. No, buying a put is not really shorting. Buying a put, it could be different meanings. It could be bearish or it could still be bullish. We'll talk about that. That it's not always that if you're buying a put, it means you are bearish. It is like if you're buying an insurance, are you bearish on your house? Do you think or do you wish that the house burns down? No, I'm buying a protection. So it depends on what you have on your portfolio. then only then you should know you can determine whether buying a put or a call is bearish or bullish. So actually I had a podcast where I gave a lot of examples and try to clarify this myth, because people say, I know my friend who bought a put, it means the stock is going down. I mean, no, you cannot never make that judgment. It depends on what your friend has in his portfolio. And until you know that, you can make a judgment whether it's bearish or bullish. So buying a put doesn't mean that I'm bearish or I want to short the stock. It depends on what else I hold in my portfolio. So if you go to the podcast, I think the title of the podcast is, if you before you follow, or how it could be dangerous to follow the trades of your mentor. Because if you see that your mentor has just sold a put without giving any explanation to you, or bought a put, and you assume that the mentor is bearish and you sell your stocks in your portfolio, that could be the worst thing you could do, because someone would have bought a put and might still be bullish. All right, let's move on. We're going to talk about motive 2. I'm long-term bullish. I'm working in a company. I've got a good amount of employee stock options lying in my E-Trade account in US. At least the companies that I worked for, all of them use E-Trade for ESOPs. So that's why I'm saying E-Trade. I don't have any affinity for E-Trade. But those stocks are lying there. Can't do anything. How can I generate some income without selling the shares? So how can I get some income every month, or at a or at regular period, without selling the shares? So what we can do, if you hold stocks and if you want to hold it, and if you want to generate income, sell a call against it, but choose the strike price very far away, at which you won't have seller remorse. So for example, let's go back to the previous one. Oh, okay, let me just bring this up. If I'm working for Snap and I have Snap shares, right? Remember, my previous motive was that I wanted to sell the shares, but I wanted to sell it at a little better price than it is currently. And that is why I went and sold at 55. Now my motive is, I think my company will do good. I don't really want to sell it right away, but these stocks are not doing anything. I may want to earn little income. So I will go ahead and pick far away price at $70, which I think, oh, Snap probably will not hit $70. We are at what, $50? It is like 40% jump. Probably won't happen in 30 days. But if I sell this, I will be able to get some income. It's not too much, but shares are, just by doing this, I will be able to get $26 or 26 cents on one share. 26 cents on a $50 share is, engineers, 26 cents on $50 shares. What percentage? 0.5%. So I can still generate at least 6% return on capital while having 40% margin on the upside. So in this case, you go ahead and choose very far away strike price. Okay, and make sure you won't have a seller remorse. But if you have a momentum stocks are generally called which makes huge movements up or down. In recent times, we have seen stocks like Alteryx, Datadogs, PagerDuties, Stitch Fix was up like 30% after earnings. Those one, if you're working on one of those company, and then say if you're working on Snap, and Snap is momentum stock, if you hold 1,000 shares, maybe sell it only 2 contracts, sell 3 contracts, so that in case if Snap becomes 80 or 90 on the 31st, okay, you made less money on only 300 shares. You still have 700 shares available. Right? it will reduce your seller remorse. And believe me, most of the queries which I get from friends or folks in the investment club is not that I'm losing money. Most of the people, they they are sad because they made less money, and then go, oh, I shouldn't have sold this call because now the stock is higher, but I have to sell it at this strike price. I'm losing money. I'm like, no, you're not losing money. Your portfolio is higher than when it was when you did this stock, because people have more seller remorse. So if you have that, maybe sell only a portion. Do a call only on a portion of your long holdings, or you can do a call spread. I'll talk about call spread later because we haven't introduced the concept of spreads yet. So there are strategies in which you can use to consistently generate some income. Whenever you get that premium, it reduces your cost basis. And do it for next 30 days, rinse and repeat. And I have done this on many stocks in my portfolio. Those who have been chatting with me on Slack or we talk on in our Saturday sessions. As we take examples of stocks. I bought this at $40, and now my cost basis is like $25 because rinse and repeat. Keep selling premium against it, and then even if stock is down, it's okay. I have reduced my cost basis a lot. So again, be aware. Pick up a strike price at which you won't have a seller remorse. And say, in case of Snap, instead of picking 55, if you're still bullish, you want to hold your stock, maybe pick 70, maybe pick 65. Because even if it goes to 70, you have made a lot more money. Probably if it goes to 90, you may not make money beyond 70, but from 50 to 70, you should be happy with it. So using this, you can generate consistent income. Means if you're sold at 70, there's very little chance that it will actually hit 70. So you will retain this $26. What do? 15 January, go and sell it for February. Right now, February is not there. By that time, it will be there. Or sell it for March. Do it again. If depending on where the stock is, pick up a strike price which is very far away, and sell a call. So you can do it and generate your income consistently on a regular period. Okay, I had an example already. Okay, so some of the mistakes that I see people doing in trying to generate that consistent income is what I want to share. Let me just see any other questions. If you already have shares in a covered call in your portfolio, how do you let the brokerage know that you're using this? Do you state it somehow in your order for covered calls? No, you don't have to let a brokerage know. Your brokerage firm systems are smart enough that they will mark this as the moment you sell it, they will tie those shares or they will hold those shares. They will keep that aside. Those will lock those shares saying this is now used for that covered call. In your platform, you will just go and say, I sell call. If you don't have the shares, then and you don't have a privilege to sell uncovered calls, your brokerage system will not even allow you to do it because they will say, you don't have a privilege to sell an uncovered call. But if you have a shares, the system will automatically map it. Or say if you have 100 shares and you sold one call, absolutely no problem. It will go through. You try to sell another call, your system will say, oh, sorry, you can't sell uncovered or naked calls because you don't have privilege. So you don't have to tell anything. The system will understand it automatically. But you can see a question, but you can always change the date of that call, can't you? Sorry, was it when I was talking about the picking the expiration period? If that's the case, it's all up to you which expiration period you want to pick. And again, if you're a part-time option trader, might want to pick 30 days out. because you don't want to log into every day in a system and see what's happening. Maybe pick 30-day out, or if you want to go further out, say if I go 16th April, right? I can get much bigger premium at 70 or 75, but now I'm giving Snap a lot more time. A lot more things can happen in 122 days. I know that maybe in 30 days, it will not go from 50 to 70, but in 122 days, it could. We don't know. There's more time, more things can happen. So based on that, you pick up a time. But you can pick up whatever expiration period you are comfortable with. Yeah. Okay, question. Okay, sure, Manoj. Is there always a buyer for these options even at high strike prices? That is why I said keep an eye on the volume. You will see if there has been enough volume or not. So there is some volume, and you will also get to know how big is the difference between the bid and the ask. That will tell you how difficult or easy it might be to fill the trade. But if you have a volume, you can see how much volume is on each strike price. Question from Ross, is there always a buyer for, oh, sorry, I just addressed that one. Okay, okay, there is another one. How does a brokerage decide which slot to pick? FIFO, most of the brokerage, I think by default is FIFO, but on some brokerage platform, you can actually go and change your tax slots. I don't think I've ever done it, but if you are really too picky about which tax slot you want to pick, brokerage firms do allow. I know on TD Ameritrade, you can't do it on a TOS platform, but you have to go to TD Ameritrade website, and then you can say assign this trade to this lot. But otherwise, most of them pick FIFO. That's a default. So if the volume is 1, that means there is only one buyer? No, the volume shows how many contracts have been traded today. It may be buying or selling, but it means there are some active participants that have participated in call option contract at a strike price of 70 today. That's what the volume will tell you. So if you're trying to sell something here, there's a chance that people are interested in it. So generally you'll have the most volume near where the stock is currently. And as you go further away, the volume starts to dwindle. That's the general case. In some cases, you will see some high volume at a strike price, and then people try to figure out that it might be telling us something. It might be giving us some indication about where the stock is going to move. So remember, a lot of option activity. There's a whole business around analyzing option activity and trying to figure out where the stock's going to do. Different topic, not for today. All right, let me just cover these rookie mistakes. We are running out of time. Stay here for 5 minutes, then I'll come back to the questions. So what I see people doing who have recently started option trading is they buy stocks to sell covered calls. It's not that they like the stocks, but they are seeing that there's so much premium in the calls. They're like, oh, I want to buy the stock and sell the covered calls. Don't ever do that. Buy the stock if you love the stock. That should be your first criteria. Stock is more important in this case, not the premium that you're getting from calls. Recent times, I've seen my friends trying to do that. I'm like, no, don't do this. Electric vehicle stocks are super hot. They have a very high premium, but buy that stock not because you can get a high premium by selling a call, but because you like the stock, because you've done your study and you think that company has a future. Do it reverse. That's exactly what I'm saying. If you like the stock, then buy the stock and then you sell a covered call. Other rookie mistake. Some people sell calls many months out. They'll sell a call 12 months out. When you're selling the call 12 months out, which is called leap covered calls, we'll cover probably in some other session. We can talk about leap options and what's the use of leap options. It has got its use, that is why it exists. But I see people sending calls which are very far away. When you do that, you don't get enough premium. When you do a shorter duration multiple times, you get more premium. So the premium is not linear, means it doesn't always increase in the same increment as your time period goes. So say for 30 days out, if I got a premium of $2, if I go and sell 10 months out, I'm not gonna get a $20 premium. So maybe sell 30 to 60 days out. That's an ideal, but even 90 days out, I won't be mad. But don't just go and sell 400 days out. Third rookie mistake, people focus more on option. Again, I want to repeat it over and over again. I've seen people falling into the trap. They learn something new called options. They say, oh, I can sell some calls and make some money. While I'm holding the stock, okay, I'll pick this stock because this has got a lot of option premium. Don't focus on that. Focus first on stock. Rookie mistake is they focus more on option than stock. Remember, option is a gravy on the stock meat. The most risk on your portfolio comes from stock. The EV stock that you picked at $50 and you sold a covered call and got a premium of $10, which is 20% of your $50 cost basis, that stock probably could go down to $10. It's too volatile. And most of the risk in your portfolio is because of the stock holding. So make sure you like the stock before you buy the stock because you want to do covered call. Don't do that. Same thing. Some people get too big on a stock position to capture the large premium by selling many calls. Right? If you buying 1,000 shares of a stock, because then you can sell 10 contracts of covered call. What you're missing is the amount of a risk you are taking on by buying those 1,000 shares. Other rookie mistake. If you have 1,000 shares, because you're working in a company for many years and you got 1,000 shares from your stock option, don't sell everything at one strike price. Right? In the case that we looked at of a snap, maybe I'll sell something at 70, sell something at 75, sell something at 80. I'll spray to different strike prices so that if the stock really goes high, at least I'm not cut out at everything at 70. I won't have that seller remorse. Again, remember, your stock position will constitute bigger portion of portfolio. Make sure you love the stock more than you like the premium from call option. You will be married to stock. You will have to live with that stock. And if a stock falls down, your portfolio will be impacted. So before you are looking to generate some income from selling calls, do your study. First figure out that yes, you want the stock in your portfolio. Great, get it in your portfolio. Then we talk about you anyway have the stock in your portfolio. Now what can we do to generate some income from it? That's where the call option comes. Okay, things that you need to watch out for is dividends and earnings. Say if you are selling a call option 30 days out, make sure there is no dividend coming in between. Because when there is a dividend coming in between, your call options will do something funky, which is unexpected. I'll cover in later sections because I haven't yet touched extrinsic premium. But if it is a dividend coming up, hold on, don't do it. But if you're in a growth company, holding a stocks of growth companies, they don't do any dividend anyway. Other thing is keep an eye on earnings, because in earnings time, stock could be very volatile. Like I gave an example of Stitch Fix. And this is a real example. Again, this is not a recommendation, but I'm just sharing what happened with me on Stitch Fix. So I had stock was at 36. I had sold a covered call at 42 or 43, right? Which means I gave myself $7, which is almost 20% upside on Stitch Fix. So fine, it's okay if it get called away at 42.50. 43. And then the stock actually jumped 45% after earnings. The stock was at, I think, 50 or something because they had earnings. I was still okay because I had sold so many covered calls on it that my cost basis was almost $16 or $19. So for me, it's still okay. But earnings can do stuff with the stocks. Your stock could suddenly jump 50%, 60%. In that case, if you don't have seller remorse, then you're fine. But I've seen many people having seller remorse because then they will come back and say, I shouldn't have sold this covered call because now after earnings, stock has jumped 40%, but I have to sell my stock at my strike price. You never know. Stock could have gone down 40%. In that case, you would have been very happy. But if you have that seller remorse, then don't sell while you have earnings before your expiration period. Keep an eye on that. All right, last slide for today. Use covered call to sell a stock at a higher than market price. Motive number one, I want to sell my stock, but I want to sell it at higher than market price. I'll go and sell a covered call. Or I want to hold the stock, but I want to generate some income and reduce my cost basis. In that case, pick up a strike which is very far away and sell a call. And this is how you can create your own regular dividend on shares that you have in your portfolio. And if your company also pays dividend, that's a double bonanza. You got your own income stream, plus you're getting a dividend from a company. It's a bullish strategy. So in this case, someone asked, right, selling a call means you're bearish. If I'm holding a stock and I'm selling a far away call, I'm still bullish. I don't want stock to fall down. So if someone tells you that he sold a call, don't think it's a bearish on a stock. It is still a bullish strategy. I still want stock to go higher because most of my portfolio is depending on the stock value, not on the call. So be careful. In options, you cannot figure out by knowing a person has bought or sold a call or put whether it's bullish or bearish. You have to know what else do they hold in their portfolio. Yeah, portfolio is impacted more by the stock position than your call position. Okay, before we go, homework for you. Enable options trading your brokerage account if you have not already. This was a homework from first drill. Select cash secured put for the stocks that you won't mind. But if you already have shares, sell a covered call. Maybe do it only for a portion. So if you have 400 shares, maybe sell 1 or 2 calls and let the other 200 shares sit there, and ride up if the stocks go high. Congratulations to all of you. You have successfully finished drill number 2. Let me take any questions. Sorry, we are over 10 minutes, but now I'll be around to answer any questions. Let me stop the recording now.